What's up, you guys? Hey, what's up? Hey, we're back. Show number 2. This is Dollars and Cents with David and Carlo.
What's going on?
Again, thank you guys for checking us out. We hope you found value in our first show and kind of where this show is headed and the different topics that we're going to be touching on. And really, in a nutshell, our job is to make you money, help you keep it, help you protect it, help your family, have it continue to grow for generations in any and every way. So real estate, mortgage, life insurance. We're going to be talking about a very specific topic today that is very, very important. One of my favorite topics, speaking from experience, which is what is called an IUL. Carlo, what's an IUL?
An IUL is a permanent type of life insurance product, right? So there's 2 types of life insurance. There's term, which you only get for a certain term, 10, 20, 30 years. And then there's permanent, which never expires. And an IUL is a permanent side of policy, right? It's a life insurance policy that has a cash value account. So IUL stands for Indexed Universal Life. The I, indexing, means that the cash value account is tied or mirrors a stock market index like the S&P 500. If the market performs, you're able to have upside growth and earn interest, compound interest inside of your cash value account. However, here's the unique part of an IUL. If the market crashes, you're guaranteed not to lose a single penny of your money or your gains up to that point. U stands for universal, which means flexibility. There is no limit to how much you can contribute to an IUL policy. So if someone says, if I want to put $500 a month, what if I want to put $50,000 a month? Can you do that? You can do that in an IUL policy.
And hate to interrupt you, but compare that, another little segment that we can get into, compare that versus like an IRA where you are maxed out on the amount that you can contribute yearly, correct?
That is correct, right? So IUL can also be called, or just cash value life insurance in general, because there's different types like whole life as well, but we're talking about IUL. It's often called a rich man's Roth IRA. And the reason why is because in a traditional Roth IRA, you're limited on how much you can contribute. I believe right now, 2024, you can do about $7,000 a year. Okay. Don't quote me on that. Maybe if you're over 50, you can do up to $8,000, but you're limited. So for someone says, well, I'm making more money now. I'm in my 50s. I want to contribute more than $8,000 towards my retirement for tax-free. You're limited, right, to $8,000 a year. So a cash value life insurance like an IUL, there is no limitation. You can bypass that based on the tax laws of life insurance. Also, if you make a certain amount of money, right, you don't qualify for a Roth IRA because you make too much money, right? I believe if you're single, you make over $140,000. Uncle Sam says you make too much money to contribute, right? If you're a couple, you make over a few $100,000 a year, you make too much money to contribute. So where can I put my money and have it grow tax-free and have access to it tax-free? Right. Permanent life insurance, and in this regard, an indexed universal life policy.
So I think the majority of people are very familiar with a 401k, right?
Yes.
As their investment or their savings vehicle when it comes to work. And again, I'm new to this side of the business, so please school me. But I've heard that now, where I don't think most employers right now are matching your contributions. If your employer is matching your contribution, stick with that 401k, right? Because that's practically free money.
It's a great question.
But it's far and few in between, right?
Yeah, it really depends. A lot of employers match, a lot of them don't. So when people say, well, should I do 401k or IUL? I've heard which one should I go, Carlo? I said, well, does your 401k offer a company match? They do. Okay, how much is the match? They match me 3%. They match me 6%. Then you should be doing up to the company match.
There you go.
Not more, right? So people say, well, my company matches me 6%, but I'm contributing 12% of my paycheck. Right. I said, bring it down to 6. Well, why should I do that? Because you're not getting any tax incentives.
But you can redirect that other 6% into something like an IUL.
Yes.
Plus,
right?
6% plus. Right.
So, and the reason people put as much money in the 401k is because it's tax deferred, meaning that you get a tax break that year, right? So whatever you contribute, you're paying less taxes on that. However, when you pull that money out in retirement, you're going to have to pay 100% income tax on all of that money.
Right.
So the $1 million question that everyone should ask themselves, do you believe taxes by the time you retire are going to go up, meaning higher than they are today,
Right.
or are they going to be lower?
Right.
What do you think most people say?
Higher.
So-
Much higher. And it's not like you're going to get grandfathered into that lower tax
Yeah.
rate that you when you were contributing, right?
No,
You're going to
not.
get taxed at what it is at that time.
Exactly.
And I think it's safe to say, speaking for myself, taxes are going up.
100%.
Looking at taxes
I mean,
are going up.
Taxes are going,
Right.
they're going to go way up. And we're Californians, man.
Right.
It's nasty out here,
Hey,
right? It's nasty out here.
gotta
So
pay for all those cow farts.
we need some, we need some tax incentives here.
Right.
And a permanent life insurance like an IUL policy really gives, right, the user that ability to go put as much money as they can sock away and have it be accessible 100% tax-free.
100% tax-free. And the reason being is that you're placing post-tax money into that account versus pre-tax money as you would be doing in your 401k. So the money that you're dumping into your IUL is going to be the same dollar for dollar that you're going to get when it comes time for you to use that money at whatever moment that might be.
The cash value account, yes.
Cash value account. I something comes to mind. I just met one of Carlos' good friends a couple weeks ago. His name's Manny
Soto.
Manny Soto. Shout out to
Shout
Manny.
out TFA, Financial Architects.
And he said something that stuck with me. And he said an IUL is like, what is it? What do you see? Stock grade life insurance, right? Something along those lines. Does that make sense?
Yeah.
It's stock grade life insurance, right? Because you're able to grow your money as if, in a sense, as if you were, you had that money invested in the stock, which I guess you are, right?
Yeah. It's tied to the stock
It's
market
indexed.
now. In terms of verbal leads, right? Because compliance says you cannot call an IUL an investment because there is a life insurance component to it. So it is a life insurance policy. However, that cash value account behaves, right? Mimics an investment because it is tied to the stock market. If the market performs, I'm able to earn a return just as if my money was in the stock market. However, on the flip side, if the market crashes, I am protected from losing that money.
That's huge.
Big time.
And we all know what's happening right now in the stock market. I mean, it's always a rodeo show out there, but Bank of Japan is going through these things. There's a war going on the other side of the continent. I mean, shoot, there's stuff happening all together where you just don't want. Do you really want to take that risk in having your money being able to just dump on itself without having any type of stop loss, right?
Absolutely.
Really. And that's what we're trying to do.
Yeah. Yeah. And what I would like to talk about is where a lot of people ask me, why is the money tax-free? I don't get how is it tax-free? And I want everyone to understand that because this is a question I get a lot that is very misunderstood. The reason that money inside of a cash value account of a life insurance policy, such as an IUL, is 100% tax-free is because you are borrowing against the policy, right? So another question I guess, like, why would I want to borrow my own money? You're not borrowing your own money. You're borrowing the insurance company's money. Okay, so IUL has a lot of similarities to how a house behaves. This is why we bridge, right? Because in a house is an asset class, right? The equity, right, is that you can access it. Same like a policy. So look at a policy like a house, right? It's the asset. The cash value account is the equity. When you borrow against your house, you're borrowing the bank's money, using your house as collateral. When you borrow against a policy, you're using the insurance company's money, using your cash value as collateral, right? So you borrow their money, and anytime you borrow money, you do not pay taxes, right, on a loan.
Right.
But you pay interest.
Right.
Albeit it's a very nominal interest rate. Especially in this environment, you're looking right now at a net 1%.
Nominal for an IUL. And I
Yes.
want to make that distinction because, there is an aspect of being your own bank when it comes to this, right?
Yeah.
And please don't quote me on these numbers. These are very generalized numbers. But for those people who are considering getting a HELOC, which is a home equity line of credit, that interest rate that the bank is going to give you, let's say on average, is going to be 10%. Normally, those payments are interest only on top of that. And then it's only fixed for a certain amount of time, right? Whereas if you're going to be borrowing against your policies,
That's correct.
your cash value,
There you go.
that interest rate, let's say it's anywhere between 1% to 2%, but that cash value is also growing on the index side of things about.
Depending on the market, you can average anywhere between, I'd say, 7 to 10% interest.
So if you're borrowing, let's say at 2%, but your account is growing at 7%, you're still making money, roughly give or take 5%, right?
That's right.
That math adds up.
Yeah, that we call that the spread. And I think it's important that people understand that, right? Because when people say, I don't get how this is be your own bank, walk me through that. Well, when you put your money in a bank account, right, say a savings account, the bank incentivizes you, say, give us your money. We will pay you an interest. They pay you peanuts on a savings account.
0.002. I mean,
let's just say 1% for illustrational purposes, because they pay a lot less than that. If you give your bank, $10,000 in your savings account, they're going to say, we'll pay you 1%. What does the bank do with that money?
They lend that money out.
Yeah.
Fractional banking, I think is what it's called.
So they're going to loan you. They want your money. They pay you 1% interest, but they're going to take your $10,000 and they're going to let someone else borrow
and
it.
loan that out at 10%. Right?
A lot more right now, right? So let's say 15%.
Right.
So if you give me money and I say, hey, David, I'm going to pay you 1%. This is your bank. You say, okay, yeah, hold my money for me. You give me $10,000 and then I let someone else borrow it in the form of a loan at 15%. We net 14%. That's the spread.
Right.
Right. So because of information and education now, people are becoming a lot more wise to the banking hustle and how they've been able to do so well. That system is slowly in a decline right now, right? People are becoming a lot less trustworthy of what banks are doing with their money and wanting to put their money in a bank. So they're moving into life insurance because in life insurance, it's like, well, if I'm going to give my money to the bank, I might as well give it to my policy and I can just borrow against my own policy. And check this out. When you borrow, no credit checks, right? No monthly payments on this loan.
Bam.
100% tax-free.
All day. That math adds up.
Big time.
Right?
Right? So I can borrow. So let's say you have $10,000 in your cash value. How much could I borrow? If you structure that policy correctly, and this is why you want to work with someone that does this correctly, you want the least amount of life insurance that you can legally get away with. Because life insurance, there's a cost. The higher the amount of life insurance in a policy, the higher the cost of the policy. That could eat into your monthly or annual contributions. The lower the amount of life insurance inside the policy, the lower the amount of cost that comes out of your contribution, which means
it's feeding more to the cash value,
which essentially is the whole point.
Right.
That's what we want. We want the least amount of death benefit that we can legally get away with. So the majority of our money is going to the cash value that we have access to day one, 100% tax-free. How much? 80 to 90%.
And one might be thinking, how soon can I get that money?
If you approve today, you can borrow it tomorrow.
There you go. And I think that's an important something to hit on because I've gotten asked that question a couple times. So
yeah,
it's your money. You get to use it as you wish.
So I'd like to talk about who is this for? Because a lot of people, well, who would an IUL be for? Are we running out of time there?
We are.
Right.
but that's a great segue into the next show because we do want to touch on that. So I'm gonna go in just close this segment out today, but we will go ahead and move on to that topic because it is important for y'all to know who's it for, why would you want to use it, how can you use it, when can you use it, and everything else that comes with that. So you guys, thank you again for checking us out today. 15 minutes with David and Carlo. This is Dollars and Cents, and we'll be seeing you soon. Peace.
Peace.